Hi, Jennifer Hernandez. What affects the interest rates going up and down, and why do they happen so quickly? First of all, I've been in the business since 95. So back then, I'm dating myself, back then it was much slower. Rates changed every couple of days. We didn't have the ferociousness of immediate data. And so it really did not happen that quickly, okay? Interest rates were published on paper rate sheets. It just really, really was slow. But now, fast forward, we're in the 21st century, well into it. Everything is real time. The minute that Wall Street is changing, I can tell you that all the investors around the country, they put a freeze. We get notices and alerts and text and everything else that says everything is suspended. The new rates will be out shortly. And everyone's waiting with bated breath. Are they going to go up? Are they going to go down? What's happening? Usually we can tell by what's going on in the market. So without getting too intricate, I just want to give you the bullet point. If the stock market is going really bad and the stock market is going down, that means that investors on Wall Street are looking for the safe haven of the bond market. If you own bonds or know anything about bonds, they are totally safe. The return, the yield, the return is really low, but it's constant, right? Bonds are the buying and purchasing of debt so that companies and schools and public entities can do business and have money, right? So those are what bonds are. So when stock market's tanking and someone is tweeting or someone is saying something on Facebook, it gets out immediately. Investors worry and they take their money out of stocks and they literally go dump it into bonds. And they're like, we're going to go buy bonds for a while. It literally happens just like that. And so it's instantaneous. And so when more people are buying bonds, then the yield or the interest rate goes down. So when demand for bonds or the price of bonds is up, the yield is inverse of that and it goes down. It's just kind of economics 101. I don't want to get too complicated. On the reverse side, if the stock market is doing great and there's economic news that the average people in the country are earning higher wages and unemployment is low and the country is rocking and everything is great, stock is up, investors feel good again, and they take the money from the bonds and they go dump it in the stock market. It literally happens just like that. So then the interest rates will go up because there's not the demand of bonds anymore. So that's the relationship. So if there's good news in the economy, rates are up. If there's bad news in the economy, rates are going down. It's just like that's kind of a good gauge. So I hope that this has been helpful. Happy to elaborate if you just call me, and I'll talk to you soon.